Hey everyone, welcome back to the second video on my YouTube channel. Today we're going to be going over the type of stocks that you can invest in. So the breakdown of stocks is really into three major groups. You have small cap stocks, which you can see in the visual below, are going to be companies that have a market value of 3 billion or less. And if you don't know what a market value is, it's the amount of shares times the share price. So basically small cap is going to be 300 million to 2 billion. Mid cap will be 2 billion to 10 billion. And large cap will be 10 billion and above. Now, there's two really different types of stocks. It's going to be your growth stocks and your value stocks. So your growth stocks are the companies that you're betting on to have a super fast growth and really high potential future, meaning that over time they will gain value and increase the stock price. Now, a value stock is a company that has already gone through its growth and is sitting at its share price, but you as an investor believe that that stock is undervalued, meaning that, for example, if you have a $30 stock that has a true value of 35, it's trading $5 below what it really should be trading at, meaning that if you buy this at 30 in the coming months or even year, the company will grow back to its true evaluation of $35, meaning you make $5. Then you have domestic versus international stocks. And basically a domestic stock is going to be a US traded company. And then international stocks would be anything but a US traded company, which international stocks are a little bit more riskier, especially in China. Very shady. So I would stay away from those. Now, there's two main ways that a company will go public, or basically going public is meaning that individual investors can buy into your company. So the first way is going to be an IPO, which is a initial public offering. This takes a long time to start, usually over a year. A company needs to go through its finances, make it public, and then when the IPO starts, they put as many shares as they want out on the market, and then people buy that share based on the price they see fit. This is the more typical way to go public, but more recently, there's been a SPAC, which is a special purpose acquisition company, and it's very new, but basically a SPAC, you start a shell company or a different company, and this it's not an actual company, it just exists on the market, and the company literally is going to have a couple of people on a management team, an account, and a little bit of startup funding. So when a company wants to go public, they'll join with this SPAC, and then that SPAC becomes the actual company. It's basically a merger. Now, an IPO usually starts a little bit higher and loses value after its first year, and then will recalculate to be a true share price. Now, another type of stock is a dividend versus non-dividend stock. So a dividend stock is a stock that's going to pay you out every quarter or every year some money for owing part of that company. A blue chip stock is basically a stock that has been super popular in the market for a long time. It has super good financials, and it's not gonna depreciate over time. So this would be your companies like Google, Facebook, Apple. They're not going anywhere. They're still growing. And then you have penny stocks, which is going to be companies with lower than a $300 million valuation, trading at super low amounts of money. Hence the reason they're called penny stocks. Super risky. You're risking they could go down to zero and go bankrupt super easy, but they also could go maybe from 50 cents to $1, and that's a 50% return on your money. Here's the little classroom activity. You got your introduction, this video, a worksheet, a review, and then some questions to end it. Thank you everyone for watching. Make sure to subscribe to my YouTube channel.